Welcome back, everyone, to another edition of Macro Matters, where we talk about the macro that matters for our CFA Society Chicago members and their friends and all of our guests. My name is Rich Excell, a charter holder and member of the Society, and I'm once again joined by my colleague in both the CFA Society and the University of Illinois, Tony Zhang. Tony, welcome.
Hi,
Good to
Rich.
see you again.
Hi, Rich. Yeah, it's good seeing you. I think that what had happened over the summer might not be happy for many of investors, especially over the past 1 or 2 weeks where we actually start to see the volatility start to pick up. And I think this will be a lot for us to actually discuss today.
Yeah, I agree with you. There's a lot to go on. This first week of September is full of tons of data, and I think you're absolutely right. We saw some volatility in August. We talked about the deleveraging event,
Yeah,
talked about the fact that maybe the market didn't even have time really at that point to change its mind about growth outlooks, et cetera. But this week we get a lot of economic data where the market is maybe now starting to think about, are we going to see growth, right? Because
definitely.
think about it, the market is pretty much content that inflation, that we're not going to see any more inflation, and that's why we are resolved to the rate cuts. But now the biggest difference is whether or not we have a soft landing or a hard landing, and the difference there is it comes down to jobs, and we get a lot of jobs data this week. Here we are, the first week of September, people coming back from vacations, school starting, as we know, conferences starting. The seasonally most difficult month in the year for the market every year. So September is always one that has some of the bigger drawdowns. Most people think of October, but it's actually September. So
Yeah.
it's kind of a precarious time. And so as we've been doing lately, I wanted to share some screens on Bloomberg and then have Tony and I talk about those. And so I'm going to start, Tony, with a screen here that looks at, because when we walk into the markets, looking at Bloomberg yesterday, and the thing that I noticed was that everyone was talking about the Chinese PMI that came out, and that was leading to weakness in the commodity market. So here on
Yes.
the screen, for those that don't see it, I've got the China PMI in white. I've got the oil commodity and the copper commodity. So I have two economically sensitive commodities, and I've got the China PMI, and that obviously China's second largest economy in the world, big importer of commodities because of the manufacturing base. So, it continued. We've seen here now probably about 4 months in a row, the Chinese PMI is disappointed to the downside. We came into the year optimistic of Chinese growth again, and it seems to be disappointing to us. And now the commodity markets are starting to react to that, particularly the oil market. Any thoughts on what we're seeing in the China PMI and Chinese economy?
Yeah, this is actually a very good moment for us to talk about the Chinese PMI. And China which actually have been known as the center of the world manufacturers, like lead to I think the volatility market of the commodity, just based on the demands and consumptions like internally. And here, whenever we actually look at maybe trying to think about what had happened in the commodity market and what might happen in the future related to the future like commodity volatility, it's actually always good to look at the Chinese PMI data. And the Chinese PMI data apparently showed the weakness actually slightly worse than expected. And this is just not I think an incidence. If we actually look at the earning report from the top 300 companies in China, quite like the S&P 500 here in China, we actually look at the Huxin 300. So basically the largest 300 companies in China, which actually range across most of the major industry in China. If we actually look at their earnings in the second quarter, here they pretty much already finished most of the earning announcements. The revenue actually, instead of going up, actually went down roughly about 1.4 and 1.5% across the board in general. So that's actually telling us that Chinese economy still actually haven't really reached to the bottom and still trying to find a way where they can stabilize. And this actually will be reflective to how investors' perception about the economy and also the economy of China, and simultaneously the demands for the exports of China. Now here, the PMI is a great indicator, which actually just show the reality here. Now with the weakening of the PMI, that's like also signaling the maybe lower demand from the commodity and energy, oil, and also kind of the metal. So we continue to see the weakening of the commodity price over the past few days, just after the release of Chinese PMI data. And this actually also has some kind of a rippling effect to us and to the rest of the world, and not only actually to the United States, but also to the rest of the world here. And from what we have been discussing over the past 2 weeks, 2 years, sorry, that because of some of the political tension between two superpower of economies like in the world, that we have continued to see the deglobalization process continuing. What that really means that China actually has shifted their export focus from the United States to actually back to somewhere else, like Europe and maybe Africa and Southern America. This is something that what we have been hearing for so long time. And Chinese economy had been also very resilient because of the shifting of the focus, because of the demands from Europe due to the war between the Russia and Ukraine and somehow. But the effect of the kind of war demands actually have been waning. That means like Chinese economy had to find another way actually to continue to strengthen their exports. This is something that what might have been struggling for many of the top Chinese companies out there. And as one of the largest super economy in the world, the weakening of the Chinese economy would also signify or signal that maybe the earning or the revenue for those international company in the United States, which actually have large exposure to Chinese market, might be weakening. This is something that I think investors in the United States should actually pay attention to as well. So that's maybe the high level discussion. And I guess this will be a lot if we can continue to discuss. There's a lot of things going on, Rich. What do you think?
Yeah, no, I hear you. I think to me, I mean, obviously we're talking, we know Europe's been weak and has been weak for some time, right? That is kind of what it is. The U.S. has been strong for some time, and we're going to talk about it in a second. And perhaps that story in the U.S. is weakening, and maybe it's weakening more than we thought it was. But I think there was already an expectation that it was going to slow at some level. So the hope for the next driver was going to be China. Even though at the start of the last 2 years, there was a hope that China was finally going to recover from its COVID shutdown, et cetera, because it never really had that spike the way the U.S. had after its shutdown. And each time we've been disappointed. And I think there's elements that are kind of going on here, I think we talk about the fact that obviously the Chinese economy is in some ways kind of remaking itself, right? Still manufacturing led, but maybe focus more on domestic consumption because some of the end markets are changing or weakening, et cetera. You've got demographic issues potentially. Now that's maybe a longer term play, but there are reasons to believe that the Chinese economy for the next 10 years or more is going to start to kind of have some of those problems that we saw in the Japanese economy in the 90s, which is generally a demographic weakness and weakening end markets for either regulatory or other reasons, which is exactly what we saw in Japan in the 90s. And I don't think anyone really wants to say that China is going to be the Japan of the 1990s. However, there's more signs that it is than it isn't. And so I think that's something where longer term we can be concerned about it. But near term, yeah, I think the market's responding to the fact that we expected China to grow. There were fits and starts, kind of go back to the summer. China PMI popped up and everyone's excited again. And now several months in a row, it's been weaker than expected. And it's like, okay, that was just a head fake. And we're kind of back to this weakening Chinese economy. And I think, yes, the U.S. economy is weakening. I'm going to bring up the world interest rate probability. So basically, what's the market expecting from the Fed? And if we look at it through the end of next year, right? So basically the next 15 months, you have more than 9 rate cuts priced into the U.S. over the next 15 months. Now the market had been rallying because 9 rate cuts, if you think that we're going to have a soft landing where growth slows, but recession doesn't kick in because unemployment doesn't go up, lower cost of capital with earnings that are going to still be growing because it's just a slowing economy, not a slow economy. That's the sweet spot for stocks. But the concern is that all of a sudden there's a reason that we're actually going to be slowing more than we thought. So if you're getting rate cuts because of a recession, that's very different than rate cuts just in a normalizing cycle. And so slowing commodities certainly means that inflation should maybe potentially not pick back up. I was worried about inflation maybe picking back up. And so slowing commodities maybe helps with that. But I think yesterday, Tuesday, September 3rd, we come back, and I'm going to bring this up here. The market was hit with U.S. growth news as well, not just Chinese growth news. We had the ISM come in weaker than expected at 47.2. I think it's slightly above where it was last month at 46.8, but 47.5 was expected. But for me, the internals of the number were even more important because the ISM itself leads GDP. It's coincident with the S&P 500, but the new orders to inventories ratio, some people look at the difference, but I look at the ratio within that data, actually leads the ISM and leads the stock market. And that new orders to inventory ratio collapsed. In fact, in one of the reports, the organization itself put out and talked about how the fall in the new orders to inventory ratio was one of the worst things we had seen. Certainly, we saw it during COVID. That was maybe an exogenous shock, but one of the worst drops we had seen in that ratio in 1 month period since the financial crisis. And so that is not necessarily a soft landing. That starts to sound more like a hard landing. I think that was the reaction that we saw in the stock market yesterday. 3% move lower in NASDAQ, 2.5 or whatever move lower in the S&P. The market had shifted its focus, no longer worried about inflation. In August, we got volatility, but maybe not a focus on growth yet. Now we're focused on growth solely, and that growth might be weaker than expected, not just in China, but in the US. That's a very different backdrop for risk-taking than where we had left it, if you will, when people went on vacation at the start of August, where, yes, we're focused on growth and growth may not be that good. That's kind of how I saw it. I don't know if you saw anything different than that, Tony.
Well, Rich, I pretty much agree with most of your observation, and you pointed a couple points which I think I might need to echo one more time. Especially you pointed out like a new order versus inventory ratio actually collapse. This is actually definitely brought up a huge concern, especially for company like which actually are very, very sensitive to the general U.S. economy. This is apparently a huge warning sign. And you also actually talk about the NASDAQ actually collapsed almost 3.5% the day before yesterday. And this is apparently, no doubt, very concerning to many of the investors. So here, what the market really is actually pondering over what might come next. Would that be a sign of recession, or would that be a sign of just maybe a minus correction before maybe what we typically would like to see the centaur rally at the end, right? And historically speaking, like in a presidential election year, we won't see maybe a bear market, most likely than not. And especially what had been happening over the past few days of 2 weeks since our discussion last time. Then the US dollar has weakened significantly, which actually bouncing around about 100. So roughly the 100 is actually treated as maybe the bull and bear line, and also maybe the lifeline for the US dollar. Whenever it actually dip below 100, that signifies that the demand for the U.S. dollar is weak globally, and if they actually stay above the 100, which actually is telling the opposite story, which means the demand for the U.S. dollar is strong. Or if it gets slightly more about 110, 120, this is stronger. So this actually is what we saw over the past few days, that U.S. dollar keep bouncing off around 100. So this is a very, very important line here. So the whole actually all of the investors, not just the U.S. domestic investor, but also global investors are watching over this very, very closely. So any actually vibration around this point, especially happening to the U.S. dollar, could cause the huge turmoil over the global financial market. Now, here in the U.S., anything that can signify the weakening of the U.S. economy would actually cause the U.S. dollar to weaken. And that's why yesterday and past few days, we have seen the volatility of the market actually pick up, even though normally or traditionally that September is the month that you point out very nicely, it's the month that markets show the highest volatility. And what I also saw, and that in Powell's, Federal Reserve Chairman Powell's latest speaking, that he actually typically is just pointing out the focus of the Federal Reserve has shifted away from watching over the inflation, because he pretty much is saying the direction of inflation is pretty much certainty. That's actually telling us the inflation would not go up from here, but instead it would just continue to either stabilizing or continue to trend down. So the focus from Federal Reserve actually has shifted away from looking at the inflation, but more of what based on what he say will be the employment or unemployment of within the United States. So right, so what that is telling. Now here in the past, if we actually look at the market in the past, this is like a market typically would respond positively to the bad news of economy. That means the bad news is good news.
Yeah.
Bad news is good news, that Federal Reserve might not actually continue to hike interest rate, but instead might actually start to cut interest rate. Now here, market already priced in more than 9 cuts over the next 15 months. This is too aggressively, way too aggressive, because what we have been, since what we have talked about this, like since last year, we know market has been too aggressively. They continue to anticipate or price in like a heavier cut than the reality. Okay, let's just put that aside. So here is the Federal Reserve actually has shifted focus from looking at the inflation, but more of employment or unemployment. The employment would depends on the company's revenue growth by looking at S&P 500. So now here, since the Federal Reserve has shifted focus, what we really need to look at in the market will be looking for the good news rather than the bad news. So it will become good news is good news, bad news is bad news. So yeah. So if actually the economy, so what we really like to see from institutional investors will be continue to see the economy remaining resilient. Well, not too hot, because too hot, well, we probably might see a disappointed interest rate path from the Federal Reserve, but we want to see a healthy inflation, but more importantly will be the employment rate. So this is something that we do not want to see. The high unemployment rate will actually drop significantly, and simultaneously we still want to see maybe the job opening will remain robust. So this actually is very, very important. I guess maybe later on we'll discuss about the yield curve. So I would actually leave the topic close by here, Rich. But
yeah, no, I think that you had a lot of great points, Tony. And one thing I wanted to kind of talk about that we mentioned before, I'll bring it up right now, is the NASDAQ. You mentioned, I mean, that's what everyone's focused on, right? Let's face it. that's where most people are invested in. I've even got friends and neighbors that normally don't talk about stocks coming up to me and telling me about their Nasdaq positions or their Nvidia positions. And so clearly we're at that point where everyone on the street has a position in tech stocks. And as I wrote about in my Substack this week, shameless plug for my Substack, but coming into the week, the Nasdaq futures were on a very critical point here, and I'll point out to it. They were sitting right on the trend line and right on the kind of what I like to look at, this Ichimoku cloud, whatever you want to look at. They were at a very precarious juncture where if we could either from this point start to get good data and bounce from that, and we're going to head to the new highs, or if we break through that, there was going to be a lot of room to the downside. If we measure that out where we go, you'd have probably a 10% move lower to the downside. If the data came out worse than expected, bad news is bad news, as you said, and we started to move lower. We saw that big move lower yesterday. You can see it here. I've got it in a circle on this chart. If you bring this up on your Bloomberg, just bring up the Nasdaq futures and look how it's broken the channel that it's been in for the last year. I mean, we had that blip in early August where we broke through there and the bulls reasserted control because, again, that was, I think, more of a deleveraging event than it was a growth scare. And we quickly moved back into it, back to kind of back to higher levels. We're breaking through that again. We've got other parts of the technicals. The moving averages are starting to diverge and move lower, showing a change in trend. There's a lot of negative technical aspects to this now. So I think you're absolutely right. Bad news is bad news. And if we kind of close this week here where the futures are at this point or lower, I think that's a very negative sign, and people are going to come in and they're going to be changing their opinions of this. And I just wanted to kind of show here real fast. I'll bring up here on Bloomberg, the calendar years, and let's look over the last 15 years. We can see that the 5-year average. Here, let's look at the last 10 years. The 5-year average, as you saw, September on over the 5-year period is down like 5%. On a 10-year average, September is not the only negative month, but it's the only largely negative month, right? More than 2.5% negative on a 10-year average. But look at the last several Septembers, right? 3.5, down 3.5 in last year, down 4.3 the year before, down 10 in 2022, down almost 6 in 2021, down almost 6 in 2020. That's a really bad streak that we're on. That is seared into everybody's memory. So all of a sudden, we're getting some bad news on growth. The tech futures are breaking technically. We know it's seasonally a very negative month. And as you said, the rate cuts are already priced into the market. 9 rate cuts is a pretty aggressive pricing. And so from that standpoint, all of those things you start to look at, and that is a pretty negative backdrop. And so I think I'm going to bring up the yield curve because you mentioned it. And that's one of those as well. Let's look at it over a longer period of time that, the yield curve is starting to get back to flat. And as we know, if we look at this, and I'll widen it out, if when the yield curve gets back to flat, that's when the U.S. goes into recession, right? And so we're getting a lot of signs that the U.S. might be kind of moving back into recession. If we look at it over the last 35 years or so, and I'll kind of show us where that kind of kicks in here. You can see as we get back to flat, every time we kind of invert and get back to flat, the recession starts right away. So that's something that is also on the market's watch list here of negative indicators that we've gotten conditioned where there's so many of these old school indicators that we look at, new orders, inventories, yield curves, jobless claims, et cetera. And a lot of people that are relatively new to the market, like, oh, that doesn't matter anymore. That doesn't matter anymore. And now we're starting to see that it still matters.
Yes. So certainly. This is the chart that I actually want to maybe talk a little bit more, especially when the yield curve is getting back to normal, like turning flat, not inverted anymore. That typically would in 6 months that we might expect to see a recession. Okay, that happened in the past 4 cases. That's what you show in the chart, the past 4 cases. So this time, Richard will continue to debate whether this time might be something like a different, right? We'll show the different. At least we have nothing to What should we say? I have nothing to actually to justify this is not a case, but even though a lot of people finding some argument, but here so far, at least for the rest of the year, this is the something that we could focus is by looking at the earning capability of the company, S&P 500 company. By many company actually will start actually to release their earning for the second quarter. What we have seen, like many of consumer discretionary companies report like quite strong and robust earning. So that actually gives the investors some kind of relief about the like imminent worry or imminent concern of chance of the recession. And here it's another actually interesting things that for Federal Reserve, as based on what you just showed, traditionally September is a month with high volatility, with strong negative return. But if you actually look at what had happened in October, in November, we have multiple good news, especially this year. Federal Reserve has some weapons or tools in their hands, which actually market actually call it like a fat pool, right? Fat pool. So anytime actually we see like a high market volatility, Fed might actually step in and take some action to cut the interest rate. Whenever we see the Federal Reserve cutting the interest rate, the art of recession might diminish unless there is an exogenous shock in the economy, in the U.S. economy. For instance, if there's something like a war happen or something like a big turmoil, another pandemic happen, something that we do not foresee. This, if this is a kind of a shock just come in, that we might actually see the Federal Reserve might take even more aggressive step to do something. If we recall what had happened back to year of 1997 and 1998, where we actually saw quite similar inflation level and also interest rates level back to that. This is quite. There was actually one great company called Cisco and versus like another company, great company, NVIDIA today, right? There's something which we continue to talk about, as we just mentioned about your friends all on NVIDIA. So this, we actually entering in the similar like era with technology innovation or disruption era to re-justify where the market will go. Will AI actually lead the U.S. economy into a different level or completely enhance, augmenting the productivity of the company, or will AI actually replace more of the job? So even though I have a team to actually conduct research over that, but what we have found out over the past few days is those company quite interesting. Actually, the company actually who continue to enhance or maybe raise the awareness of AI into the production line, or they find the productivity or gross profit margin continue to expand and increase, but simultaneously hiring more of the people working with the AI adoption. So this is some kind of a trend. So far, this might provide another like a strong support. Whenever we actually saw a weak like a market, Federal Reserve might still have some weapon to actually provide a paddle or support for U.S. job market employment. So we are watching over the earning announcement from S&P 500 quite closely. And this month is very, very like I would say special, because even though there might be large earning data actually coming out, but we will not hear Federal Reserve release the meeting until I think September 18th, right? So this is quite a long window, almost 2-week trading window from now on until like September 18th. So that's why lots of things could happen, and simultaneously, because of this is summer, the typically trader would just take on vacation and so on. Like the trading liquidity is thin. That's why I think there's a lot of volatility. But here, back into point is based on many of the earning release so far, like Starbucks, okay, and so we don't actually see that kind of a weakness in their revenue growth so far. And this is quite, I would say, encouraging because last quarter, when we actually saw Starbucks releasing the earning that we actually show, people might not actually drink like a coffee anymore because now here
Yeah.
this is not a case, right? This is actually turned out to be very encouraging. So what I would say is, what I'm saying is that, okay, so even though traditionally this might be concerning in September, but here we will still need to look over the earnings capability from the individual company. I think maybe before September or before August, everything what we look will be the general economic data because of what Federal Reserve was the main driver of Federal Reserve's policy was the main driver of the stock market. But from now on, I think it will be the individual company's earning capability and earning would actually drive the performance of each individual stock.
Yeah, and I totally agree. Totally agree, Tony. And I was bringing up some charts here as you were talking. I just, kind of trying to highlight some of the things you're talking about. First, as you say, I think bad news, as you mentioned before. I think a lot of people are going to be focused on, in their minds, they're going to be focused on the non-farm payroll number. I would caution against that. I know a lot of people in the market focus on it. I know the media focuses on it. I know politicians focus on it. I'm not naive to know that a lot of people focus on non-farm payrolls. But what have we seen with non-farm payrolls in the last 18 months? Every single month, the previous month's number is revised lower. In fact, it's
Correct.
revised lower more than once. And so the number that comes out will probably be revised lower. And on top of that, 2 weeks ago, we just found out that even those revisions were not enough, and they came out and revised the entire thing lower by another 818,000 jobs. And so I think it's pretty clear the Bureau of Labor Statistics has no idea what the job market looks like. But don't worry about it because there's lots of other data out there that tells us what the job market looks like. And so we don't have to worry about that. And so, for instance, yesterday, we got the ISM employment data. It came in still in contractionary territory at 46. Today, we got the JOLTS job openings, which came in last month was revised lower, and then this month came in much lower than expected. And so there's not as many job openings or not as much labor turnover. Tomorrow, we're going to get the Challenger job cuts number, and that's something people will be focused on. Are people getting fired? You mentioned that people are hiring within AI specific jobs because of productivity gains. If you look at, for instance, a website like layoffs.fyi that shows what are the net jobs in Silicon Valley right now, we've lost about 400,000 jobs in Silicon Valley in the last year, into 2023 and 2024. Look at what are financial services firms doing. Are they hiring, whether it's investment banks or consulting or private equity, private credit, et cetera? We've clearly seen that that hiring has not returned. The hiring is not there at all. The deal flow has not come back for the investment banks. You're not seeing private equity firms being able to reach kind of exit strategies, et cetera. And so the financial services jobs, again, very good paying jobs, they're not really showing signs of strength. And so there's definitely, while AI is going to show potentially some productivity gains, and tomorrow we're going to see what the non-farm productivity looks like. We're certainly not seeing any signs of strong productivity gains yet from AI. It's probably too soon to say, but we'll find out about that. We'll get ADP employment change data tomorrow. We'll get jobless claims data tomorrow. We'll get continuing claims data tomorrow. We'll get the average hourly earnings and the average weekly hours on Friday, in addition to the non-farm payrolls. And so we're going to get so many different looks at the job market, even with the non-farm payroll that everyone cares about. I'll throw that one out because I don't really care about it, but I just think we're going to get so many other looks, and we'll have a much better idea if this labor market is consistent with a soft landing or a hard landing. So by Friday, we'll have a much better idea of what that picture looks like. But you mentioned the dollar a couple of times, and I wanted to kind of point out to it because we talked a lot about dollar yen last time, right? The deleveraging that had happened, et cetera. We had seen some recovery from the lows in dollar yen of early August. We kind of bounced back, but now we're revisiting those very low levels in dollar yen here. Will we potentially see another sort of I don't think many firms had a chance even to re-lever too much, but it was a new month. So, now we're looking at maybe a trend change in dollar yen, so that the ability for hedge funds and levered accounts to source cheap funding in Japan may be in question. But I think more importantly, what I wanted to look at is, you mentioned the dollar index. And
Yeah.
I'm showing over the last 10 years the levels of the dollar index. And I've got it plotted against, the outperformance of S&P to the emerging markets. So I'll give you my interpretation of what's going on, and then you tell me what you think is going on. So
Okay.
typically, when the dollar is strong, that means that investors are worried about global growth. Because the U.S. markets, treasuries, even the U.S. stock market, which is less cyclical than other country stock markets, is seen as more of a defensive index. I know we've got the AI stuff that's been going on the last year or so, but really, traditionally, when we see the dollar stronger, we tend to see the U.S. markets outperform other markets, because it's usually a period where we're worried about global growth, et cetera. When the dollar starts to weaken, oftentimes that's because people are more excited about global growth and they're investing those dollars in other foreign markets. And we see the things like the emerging markets outperform. We see Europe start to outperform the US, and we see better global markets, even though the US market is lagging on that basis. You can see in this chart here where I've plotted the dollar index versus that SPY versus EEM outperformance. In the last almost 2 years, that started to change. Sure, we've got an AI impact on SPY, which we always see, but will we start to see, if we start to see dollar weakness, will we start to see money moving abroad into other markets because maybe there's better opportunities, or is something else kind of going on here? You mentioned that if we're worried about U.S. growth, we're worried about Chinese growth. Are we worried about global growth? I'm surprised to see the dollar weakening, but I understand why it is, because there's been a lot of crowding into the dollar, I think, in the last 2 years as we're chasing the AI story. So maybe we'll see a little bit where the U.S. markets start to underperform, maybe for slightly different reasons than we've seen traditionally. But that's kind of what I'm seeing, Tony. Tell me what you're thinking here.
Yes, the interaction among like a US dollar, US bond or treasury, US treasury, US stock market, and the emerging market actually are quite complicated. So this is not a linear relationship that we sort of like the weakening the US dollar, that we actually might see that the weakening of the US stock market, that probably might not be the case always, but this is some of the factors going on with the weakening of the US dollar, that over the past 1 month or past 1 quarter, we definitely see that the emerging market actually has outperformed the US market, S&P 500 in general, over the past I think two months. So this is something that what we have continue to see, and more actually more interesting with like a weakening US dollar, that we would anticipate, market would anticipate that Federal Reserve might cut the interest rate, or either voluntary or involuntary, that more of the rate sensitive sector would actually benefit from this rate cut, especially like small cap company and also emerging company, and some, I think, rate sensitive sector like real estate or like utility, that actually would actually continue to outperform in general. So what we saw, like the market actually institution continue to shuffle around this concept, and they actually rotate the investment out from the tech from now on, and do more of like consumer, like a cyclical, and simultaneously more of the rate sensitive sector. Now here, I'll actually might think in my own opinion is, the soft landing still the most likely the scenario here, by looking at many of the data. You pointed out the non-farm payroll data have continuously been revised down from what they report. This is a big issue, because many economists, including the researcher working for Federal Reserve, and even Federal Reserve Central Bank by themselves, governments, watching this data very, very closely. Now here, if the Department of Labor or Department of don't even know what had been really going on with the labor market, how can investors be assured that they would have the right data to make the right interest rate decision, right? This is definitely very, very concerning to me and lots of economists and also researchers in the market. So this apparently we can Rich, you pointed out there might be multiple data source where we can actually looking at the data from a different angle. But traditionally, many of the quant model have been programmed just based on the data of a non-farm payroll. And now here, if it has to continue to show a huge volatility and continue to revise down, if it's happened to be very interesting, it didn't actually revise up, but revise down. So what that's telling us, a lot of investors, so apparently, so the picture that what we have seen might be actually this, there might be some people want us to see or investors to see a good picture, not actually a bad news, especially in the year of presidential election year. So that's might actually give the wrong impression about the reality of the economies. I think many of the quant firms might struggle to interpret this non-farm payroll data.
Yeah, I would agree with you. I mean, I think that people will blame immigration. People will blame baby boomers retiring faster than expected. People will
Yes.
blame a lot of different things. But the reality is the number's always been, I think, to me, a little bit of a sketchy one. I do agree that people have in quant funds and not are the only one, are not the only ones that have really kind of focused on it quite a bit. But it's always been subject to a lot of revisions. Their birth death model assumptions are not always valid and are constantly being tweaked and adjusted. They're doing their best, et cetera. But I think, to me, I think ultimately, what I would encourage listeners to do is just ask your friends, ask your neighbors, ask your family, what do you think the job market is? I can tell you when I do that, they tell me the job market is not very good. I can tell you that I have dozens, as you do, dozens and dozens of students who are actively looking for a job who are telling me that the job market is not that strong. And these are super talented individuals that have the most current skill sets that companies should be demanding, and because they're relatively cheap sources of labor,
Yeah.
and they're not in demand right now. So that to me, and it's one data point, but there's I see it in some of the other data that we're getting, and then I hear that from students, and I'm like, that doesn't give me a good sense of that this is going to be a soft landing and not a hard landing. And again, maybe I'm biased in thinking that, but that's kind of what I'm seeing. So I
Yeah.
just want to end on one last chart here, and maybe I'll get your final thoughts too. But we don't want to end without talking about crypto a little bit, because as we kind of talked about last time, we've gotten all the good news you're going to get in some ways in a lot of in the main coins like Bitcoin and Ethereum. We've gotten the ETFs, they've come through, et cetera. The money has kind of flown in there. The prices are below the average price where the ETFs got listed. If you look at, I've got the crypto monitor on Bloomberg up now. You can look at, for the most part, most of these coins are below their 30-day, at the lower end, below their median, and some near the low end of their 30-day range. I thought that crypto's always been a pretty good canary in the coal mine of the market's risk appetite, et cetera. And it just doesn't seem that the risk, it's not collapsing, but it doesn't seem like it's a healthy risk appetite, even if we get away from the NASDAQ and we focus on other things. It just feels like no matter what risky assets we look at across the market, whether it's growth focused commodities like oil and copper, whether it's things like the NASDAQ futures, or whether it's things like Bitcoin and Ethereum, that the market's sense or desire to take risk is certainly waning right now and is not looking very healthy. But Tony, I want to get your thoughts on your last thoughts on what's going on in the economy, but also on I always appreciate your thoughts on crypto as well.
Yeah. Historically, the crypto market has been a leading indicator with the stock market, and which actually showing the risk appetite of the investors. And what we typically would anticipate, as what we discussed before, would be with the more of inclusion of institutional capital flow into the crypto market, we should see more of less of the volatility of the cryptocurrency. But this apparently is not the case at all. Over the past few months, 2 months, as what you presented here, many of the cryptocurrency actually have been trading below their 30 days like moving average. This definitely a very bearish sign for cryptocurrency for a long time. We don't actually need to utilize the cryptocurrency as a gauge of the U.S. economy, which is still not a case because we haven't seen the big adoption of the cryptocurrency into the daily life of many U.S. citizens. But cryptocurrency definitely is a sign for the risk tolerance of the institutional investors here with the ETF, Bitcoin ETF, Ether ETF, now continue to trending down, like continue to show the sign of weakness, not as strong at all. And typically with like Federal Reserve cutting the interest rate, that we should actually expect to see high liquidity over the market. If we actually recall what had happened back to year 2020 when Federal Reserve actually stepped in and cut the interest rate to zero due to the pandemic, right? At the moment, like we saw the crypto, all the long duration stock, like this, those kind of a small caps company within the AR case, like rally significantly, and similar things happen to crypto asset here. Given the pending the market pending 9 times cut, or the market had priced in, that we still haven't really seen a strong performance of the crypto. That's actually telling us that at this moment, the investors, no matter whether it's retail investors or institutional investors, should actually stay vigilant in this market, and very cautious over this month. This is what the cryptocurrency is actually saying. But underlying philosophy of the cryptocurrency has changed dramatically. As what we know of originally, that cryptocurrency was introduced with the philosophy that this should be a decentralized platform, or this decentralized medians from the central bank. Now, all of the cryptocurrency had been introduced and trading actually centering around the performance of the general market, S&P 500 or NASDAQ. It's more, more of a beta play of the cryptocurrency versus NASDAQ. This is how I look at it at this moment. So there's a lot of things, a lot of volatilities like in crypto market actually telling me maybe the investors' appetite within the cryptocurrency might start to shrink or contract looking forward. So that's the way I interpret that, Rich.
Yeah, I would agree with you. I think the nature of the marginal investor or trader in crypto has changed a lot through the cycle, right? The early adopters were not going to sell, et cetera. And they're still not selling. And there's a number of people that were in early and that's just supply I feel that's a lot of supply that's permanently out of the market. And what I'm focused more on is what's the marginal trader investor going to do. And to me, the marginal trader investor is the person that got in either via the ETF or because of the ETF, and what's going to happen. And what do we see on this chart here? I've just got the 1 year kind of chart up. You know, prices below both the 1 month, 3 month, and 12-month moving average. That's not good, right? I've drawn on here an average line. It's the average price at which the Bitcoin has traded since the ETF was announced. So on a year-to-date basis, that's 62,500 roughly. We're below that. I look at this, and if we look over the last 5 months, maybe, what do we see? We see a series of lower highs and lower lows. Every market that you look at, if it's a series of lower highs and lower lows, that's a market that's facing a lot of exhaustion, and it's one that's going to tend to head lower. There is no kind of technical support in this market. And as we start to, as the marginal investor, marginal trader starts to lose money in their crypto positions, which they are losing money right now on average, that's not a healthy sign. And I agree with you. Even since 2017, I've looked at crypto as been a really good leading indicator of the overall market's risk appetite. And I think that this is just another sign to me that the market is feeling a little bit more risk averse right now and will continue to do so. Perhaps there's something that Jay Powell can say in the September FOMC meeting to put in that Fed put. Frankly, if the Fed came out right now and cut by 50 basis points, I'd probably be more scared than anything else. There's one, we look at it and there's about not quite 1.5 hikes priced in. So about 35 basis points of, priced in for the September meeting, which is higher than it was, a week ago. You look at it, I think to me, the bond market is starting to tell you that growth is slowing much more than we think. And this is not just a normalization of policy. If there's a normalization of policy, as many Fed speakers have told us, the first move isn't 50 basis points. The first move is 25 basis points, and then they wait for more data to come out if all they're doing is normalizing policy. If the Fed is cutting by 50 basis points in September, that tells you that the data that they're seeing, the data they're looking at, is telling them that growth is slowing a lot more than they expected because of the lagged effects of policy, which we saw in the yield curve inversion. And that should tell the market that economic growth is slowing massively. That means earnings are going to be slowing massively, which means employment is going to be slowing massively, which is a hard landing and not a soft landing. I don't want to leave us on a negative note, Tony, but those are the things that I'm looking at. I think, again, I don't want to extrapolate too much from some of the early data points we've gotten this week. There's a lot more data we're going to get this week, but I think that's to me the lens that investors should be looking at, the news of the next week and the next few days and the next 2 weeks are really important for the rest of this year, I think.
Agree. Yes, certainly. I think given what we have discussed here, and the market sentiment has actually shifted from bad news is good news to the bad news is real bad news. So we actually, from investors' point of view, should really look at the fundamental of the investments individually rather than looking at the overall perspective. And even with the Fed puts still in place, that we still be cautious about the shock in U.S. economy, and also simultaneously where we actually see little evidence or little strengths in commodity market and crypto market. I think this is overall, I think, summary of what we had just discussed.
I think you're absolutely right, and I think on that note, Tony, we'll wrap it up and leave it there. We've been with if you've been listening for this long, we appreciate it. Hopefully, you've gotten some stuff out of it, and make sure that you are sharing this with your friends. We're just trying to educate as many people as we can on this. So share it with your friends and make sure you like it and subscribe to it, both on our podcast and on the YouTube channel, however you happen to be looking at that. So on that note, thank you to all the CFA members and guests that are listening. Thanks for joining us and talking about the macro that matters on our Macro Matters podcast. Until next time, Tony, we'll take care.
Yes, thank you very much. And next time, once we come back, we should actually talk about the Federal Reserve's rate policy. They would probably most likely would have already make the decision. As what you mentioned, that you market anticipate 50 basis point cut. This is most likely it's not going to be the case.
I think the next time we'll do it, we'll make sure that we'll see the results of the Fed meeting.
Yes. Yeah.
Take care.
Yeah. Thank you, Rich. And thank you, everyone.